Okay, this lesson is going to deal with a topic in Unit 6 for AP Macroeconomics that's referred to as the balance of payments. The balance of payments, very simply, and you want to be writing this down if you're taking this as notes, the balance of payments very simply is just keeping track of money that's flowing into a country or out of a country. Okay, so it's the inflows and the outflows. Okay, the inflows and outflows of money. Okay, and just kind of keeping track of this stuff going forward. Um, if something is an inflow, inflows are referred to, inflows are credits, and outflows are referred to as debits. And you can think of almost like a personal checking account in this manner. If you buy something with your debit card, or if you buy something with a check, the money is flowing from you to whoever you're buying something from. So that would be a debit to your account. If you are getting paid and you deposit a check, or if someone is giving money to you in exchange for goods and services, that's an inflow or a credit to your account. So if you can just always think of your own personal checking account. So, but in this case, they would ask you, like, in terms of the U.S., this balance of payments, think of the U.S. as like a person with a checking account. Is money going into them, or is money going out? If money's coming in, it's a credit. If money's going out, it's a debit. So if you buy a PlayStation, that would be a debit because the money is going from you to a company in Japan, to Sony. Okay? And what you need to now know is that there are three main parts of the balance of payments. Okay? There's a current account, there is the financial / capital account, and then the last one is the least used. It's like official reserves. And I'll kind of talk about that very briefly. The official reserves tends not even to be used so much on the AP exam, but you just need to know that it exists. It's the way central banks balance the balance of payments if they don't balance out or self-correct on their own. Okay. A couple of things that you want to assume here. Every now and then we have assumptions. So for example, like MPC plus MPS equals 1. Well, the assumption that you make here is that the current account and the financial account equal 0. Okay, so what does that mean? It means if this is positive $500 billion on this test in this course, they are then telling you that the financial capital account is therefore negative $500 billion. Okay, so that's an assumption that you can make, is that the current and the financial account, in theory, once again, this is one of those things like in this classroom, they always balance out. In the real world, it's not nearly as simple. Turning our focus back to the financial capital account for a second, it used to just be referred to as the capital account. But now, over the course of time, they're phasing in the financial account. And one of these years, and it could be this year, I've actually thought it was going to be the last two, they'll just start referring to this as the financial account only and not the capital account at all. In real life, there's a difference between the financial and capital account. They're not quite the same. For the sake of this class, they're absolutely the same. Okay, so you can assume that they are one and the same. You will not see financial or capital account without financial account, but if for some reason you do, just know that they're the same thing. And as I said, it's sort of like they're phasing in the new terminology. I actually like the new terminology better because I feel like it does a better job of describing what should be in that account. Okay, so next thing that we got to figure out, now that we have this, the balance of payments, inflows, and what outflows are, the three different parts of the balance of payments, and that the current and the financial account should zero each other out. That's where the official reserves would come in. If they don't zero out, the official reserves would intervene and balance those out to therefore make that number 0. So you can once again just assume that they balance each other out. All right. So now what we got to figure out is what's in the current account. The current account consists of three main things. Okay. The biggest by far and away is net exports. Net exports is the biggest part of this. and net exports, of aggregate demand. So if we have a trade deficit, we probably have a current account deficit, because net exports is roughly 80 to 90% of the current account. I mean, you can do some math and figure out ways, yeah, you could, but in the United States, our trade deficit tends to be so big that it by itself would give us a current account deficit. So net exports, and this is of goods and services. Okay, anything that would go in the net export category. Okay, that's, as I said, the biggest part. The next part is what's known as net foreign income. And this is going to seem more confusing to read and to write down than it is to actually understand. Net foreign income, very simply, is U.S. owned, or net foreign income, sorry, U.S. owned assets that pay income from foreign countries versus what they owe of, or what they own of ours. So U.S. owned of foreign minus foreign owned of U.S. And you're probably a little confused right now. Give me an example, Crowdy. Very simply, if you buy a German bond, and you're someone in the United States, you're someone in the U.S. here, and you own a foreign asset. Okay, the foreign asset, the payment from the bond, the interest payment on the bond, not the actual asset itself, but the interest payment on the bond is referred to as foreign income, and so that's there. Okay, so you want to think of like dividend payments is dividends, and interest payments tend to be the two biggest ones. So if you own stocks and bonds from foreign countries, the payments on those, the interest payments and the dividend payments, not the actual stocks and bonds themselves, are in the current account. Okay, we'll talk about that in a second. And the last thing is, the last thing that goes on this side is like foreign aid, and it can kind of, you can think of it one of two ways, like when we actually give other countries foreign aid. So Haiti has an earthquake, the country's devastated. When we give them money, that goes in the current account, and that would be a debit to the current account because money's leaving our shores and going there. Or sometimes when, like a worker, let's say, sends money home, or maybe so when I used to bartend at the track, for example, my barbacks were from Chile. When they would send money home, that would count in the current account because it's money, and it would be a debit because money is leaving our shores and going to Chile in that case. As I said, foreign aid, the example with Haiti. Okay, so you have net exports, you have net foreign income, which is income payments on stocks and bonds primarily that are made either to the United States. If it's made to the United States, so if it's U.S. owned, that's a credit. If other people own our stuff and we make payments, so when the Chinese buy our bonds to finance our debt, that is a debit to the net foreign income because they own foreign-owned U.S. assets, in this case, stocks and bonds, so U.S. assets. Okay? And as I said, the foreign aid. I'll explain this in a little more detail in a second. Okay, so what's now in the financial/capital account? Capital account. Okay, two main things. Real assets. What's a real asset? Buildings. Assembly lines, actual tangible, real, like in this case, not adjusted for inflation. Real doesn't mean that in this case. It means like it's actually tangible. So if you bought a factory in China, that's a real asset. That would be money going from here to China. So that's a debit, in our case, to the financial account. And real assets, and then financial assets. Okay, so the financial account has real assets in it, like buildings, assembly lines, and also financial assets in it, like stocks and bonds. So if you bought a German bond, that goes in the capital account. or the financial account. If you buy stock in Sony or BMW or Airbus or whatever the foreign company is, if you buy stocks or bonds in this, then it goes into the financial account. Now, this is a little tricky because if you look back at the previous slide here, this is the payments on stocks and bonds are counted in the current account, but the actual stocks and bonds themselves count in the financial account. Okay, so that's where it gets a little tricky, but I'm going to give you a little, like just like a mental aid, if you will, kind of something to help you determine whether something should be in the financial account or the current account, because ultimately on the AP exam, what they tend to do is list a couple of things and expect you to determine whether they're in the financial account or they're in the current account. So very briefly, the current account, little rule of thumb here, are things that go to who, hold on a sec, who bought them, or who needs them. The financial account are things that stay where they are bought. Okay, this might be a little confusing because right now I'm sure a couple of you are wondering, but if you buy stocks, don't they come to you? Well, think about what stock really is. Stock is ownership of a company. So if I buy stock in Sony, it's not as if the Sony directors wake up in the morning and they get an email basically saying, we got a big problem here. Kevin Crotty in Saratoga Springs, New York bought our stock last night. We have to pack up our headquarters here at Tokyo and head to Saratoga, New York. Okay, that doesn't happen. If you buy a German bond, it's not like, you know, the German finance department's like, uh-oh, we got to now move the entire country to Saratoga, New York. Okay, they stay where they're bought. You can buy stock in BMW. BMW doesn't move its headquarters. You can buy stock in Sony. Sony doesn't move its headquarters. Okay, so those things will stay where they're bought. If you buy a factory in China, the whole point of buying the factory in China is you want the factory to be in China. You don't want it shipped to you. Okay, that therefore would go in the financial account. If you buy, like in Jurassic Park, he is buying like an amusement park or creating an amusement park outside the United States. That would be in the financial account. Okay? A current account are things that go to who buys them. So let's go back and kind of look at this while we're talking about this. Net exports. If you buy a PlayStation, you don't get a card in the mail from Sony saying, congratulations, you bought a PlayStation. We'll have it here for you in Tokyo anytime you're in town. Feel free to use it or pick it up or whatever. It comes to you. It goes to your house. If I buy stock in Sony, okay, so now we're here. Sony itself doesn't move to my backyard, but when they make a dividend payment, which is a payment that stocks sometimes make, okay, that's kind of what that's just a fancy term to refer to as like a payout for owning stock. You get a share of the profits, if you will. When they make the dividend payment, they don't send me a card saying, hey, your dividend payment's in. The next time you're in Tokyo, feel free to stop by and pick it up. It gets wired to my account. It comes to me. If I buy a German bond, Germany doesn't move. It doesn't change location. But the interest payment I get better come to me. Otherwise, that's really annoying. Take a look at number 3, foreign aid. We don't call Haiti up and say, Haiti, listen, an earthquake completely devastated your entire country. Good news, if you stop by the White House, we'll give you a check. The foreign aid goes to Haiti. Okay, it goes to the place where it's needed. When the barbacks that worked with me sent money home to Chile, the money actually went to their family in Chile. They didn't expect their family members to come to the United States, pick it up, and then return home. Okay? Kind of following this logic, the real assets, the buildings, as I said, when you buy a building or an assembly line, it stays where it's bought. If you buy stocks and bonds, those companies don't move location. Those countries don't move location. So therefore, those things go in the financial account. Okay, I hope this clarifies things. You're about to get the handout that you do from the Morton's books or the you will notice this. The first example that they give you with the Harley Davidson purchasing the equipment from a Japanese company is a mistake. Okay, it says, I believe it says capital account, because I think the thought was capital equipment, like they were buying an assembly line equipment. But the assembly line equipment come back to the United States to Harley Davidson. Therefore, that's actually current account. So don't make that mistake. That caused a big problem that year on the AP exam in 2008. That was an almost word-for-word question, and it caused a ton of confusion. So don't make that mistake. So on the first, on page, I think it's like 302 of the packet you're about to get, the example they give you is incorrect. Okay? Hope this was helpful, and if you have questions, you can ask me when you see me in class.